Good morning, everybody. Jaden Bax here with Avenue Financial out of Calgary, Alberta. Joined as always by my cousin, the best broker in British Columbia, Mike
Hi.
Parkinson of Dominion Lending Centers out in Campbell River. How's everything going today, Mike?
Things are good, Jay.
Yeah,
It's a rainy Thursday, heading to Vancouver for some meetings and stuff. So getting out
nice.
of town, it's good, but not looking forward to hopping on the ferry and dealing with that stuff. But
No, well, we have the beautiful weather here today, so I think I might get outside and play a little bit of pickleball and get my skills going for when you come next summer. I can really
okay,
whop you
yeah,
then,
no,
right?
you
So
need it. You need it.
I do need all the practice I could get. But yeah, jumping back into why we're here every week, we're talking about rates, what's affecting them, and what's going on. And what we've had this last couple of weeks is a lot of data that's kind of going in opposite directions, right? That
Yep.
jobs data came out. What was it? 2 weeks ago now. And everybody was scared. It's we had created three times more jobs than we thought we were going to. The economy is too hot. This, that, and the other. Definitely going to see an interest rate rise on, I think it's October 25th, next
Right.
Wednesday, when they're going to make the decision. And then last week we get our CPI data that inflation was expected to be stay at 4% because of the base effects from 2022, and came in cooler than expected at 3.8. And now all of a sudden, well, maybe the jobs data isn't so important, and there are some other underlying things that are going on. But in our opinion, I think that even that 3.8 is a bit of a red herring, isn't it, Mike? It's not exactly what it seems to be.
Jay, the numbers are just numbers, man. Like I think they're making them out of the sky. Like it's like they can say whatever they want, and that's the narrative. We've been talking about this for a year and a half. They're going to tell you what they want to tell you. They're going to tell you rates are going to be higher for longer. Even if we pause, we're going to keep them higher for longer. What are they going to say? Oh, it looks like we're going to start cutting. Things aren't looking good. Like they're not going to say that, right? So bottom line is, and getting back to the numbers, like you just said, 3.8% inflation. So uh, the mortgage interest payments, because they're so high, they make up what is it, 30% of the CPI?
Yeah,
So if you
yeah.
took those, if you took those out, or if they drop in half, it's going to bring us right down to where they want to be with inflation, close to 2%, right?
Well, but the problem with that now, Mike, is, and I think we've talked about this about a month ago, some of that stuff is locked in.
It's
People panicked in this rate
true.
environment, right? And so, there's people that locked into a 5-year fixed, and so that pricing is locked in. They have created inflation with this, and there's no way to do a quick fix. They could go back
Right.
down to a 0.25% overnight rate tomorrow,
Yep.
which variable customers would love,
Yep.
obviously, right? But it's not gonna pull that stuff out of the economy. That's another
Yep.
lag effect of interest rate changes, right? It works in the inverse as well. And so it's really interesting that in this fight, they're the biggest cause now. Groceries are going down. Gas at some point, if Saudi Arabia decides to up production in 2024, which they've kind of looking like they might, will likely go down as well. So oil costs, because that's really the only thing kind of propping things up right now is interest rates and gas.
Yeah, and the government, we talked about this just before we went on here live, is that the government's, the Bank of Canada and the Fed are fighting their own governments, and we're stuck in the middle paying for it,
Yeah,
right? So
yeah.
it's very frustrating. So that keeps the inflation numbers higher than normal. A lot of manipulation out there. The governments are propping up the economy, but listen, moving forward, the economy is not strong. I don't care what they say, and it's weakening every month. Again, my opinion, just things I see. But if they don't start cutting rates sooner than later, I think they're going to have to, because it's just going to cause chaos. It's going to cause a major crisis. If so, I still think a crisis is going to happen sooner than later. They're talking about cutting rates. What, midsummer next year, Jay? Uh,
Yeah, kind of mid, like kind of second to third quarter next year, end of second into the third. Bold prediction. For me, it's happening by April, right? Like I think that's just the way that we're headed, and it's. I know it's frustrating for people in the variable adjustable mortgages when we talk to them, and they talk about, should we lock in, and we're saying hold on. But I truly believe in my heart, with everything that we're seeing, with all the data that's there behind the scenes, those variable people are going to be happy come this time next year, that they didn't lock into that, that 4-year term or the 5-year term at over 4%, like, mid fours, mid fives. Going to be very happy that they didn't make that decision, because we're heading back down, and I think we're heading back down in a meaningful way.
Yeah, and honestly, you're like, we don't have a crystal ball, Jay and I. This is just our opinion based on what we've been following, what we see. We're boots to the ground. We're seeing a lot of things. Economy's hurting. Like, it's people don't have the cash flow they had, not even close. These high rates, people coming up for renewal right now, there's nowhere to hide, guys. Like, there's nowhere to hide. When I mean that, I mean every rate you're going to get into is high. So the strategy you want to get into is something, in our opinion, shorter term. That's hopefully going to get you into something cheaper sooner than later. We don't know when they're going to move down or how much they're going to move down. We just have our opinions. But I'd be really shocked if a year from now rates aren't fairly significantly lower.
Yeah, and
we're
so
talking maybe getting down to the 3. I think that's what Benjamin Tal was talking about.
Yeah,
getting to 3%. Bank of Canada kind of rate. I could see lower. Because that's what it's always done in the past. What's gone up has come way back down, right? And that's the only tool they really have if things really take a downturn and a recession really is stronger than what they think. So
for sure. And I don't quote me on this stat, but I saw a stat the other day, and I think it was 60% of mortgages are coming up for renewal in 2024, 2025.
Yeah.
And so the 60, 65, something like that, they know that they can't lock in, because what they would be essentially doing by keeping the rates higher longer through 2024 into 2025 is locking in those inflationary rates over that period. Right. So they know if the biggest way to fight inflation going forward, I think, is to bring rates down and bring those mortgage costs down when that 60% of people is renewing over the next, 18 months, 2 years, whatever the number is. Right. So definitely something. But, the government does like to put their hands in the pie a little bit and try and do some things. And so we're seeing them messing with the banking sector a little bit right now. Chrystia Freeland met with the heads of all the banks. We got to get rid of all of these, there's overdraft charges, fees for having a checking account, all of those kinds of things. How's that going to impact rates, in your opinion?
Well, somebody's got to pay for that, right? The bank's got to make money. So, I think the banking system is really starting to hurt here. US big time. They're not lending as much. They're in over their heads in commercial. A lot of these smaller bankings and commercial lending, it's a bit of a gong show. And with these high interest rates, these banks have to invest their money somewhere. And way back when they invested in, when bonds were higher priced, and now they're half the price. So they can't afford. If everybody went in there and demanded their money, they just couldn't do it, right? So it's really turning banks, making them a lot weaker. So the longer these rates stay higher, the harder it is on the banks, and then they're going to have to make up for those profits.
Absolutely. Right? If the government is mandating that you need to stop doing this, this, and this, that has to come somewhere. And so when you do loans, like you're doing an auto loan, there's a spread on the bond that they buy and the money that they lend. I think probably that spread is going to get bigger to make up for that, $50 non-sufficient fund fee that they're no longer charging and things like that. Yeah. Same thing with a fixed rate, a variable rate. The beauty of the variable, generally speaking, what you're trying to do when you get the adjustable variable rate is maximize your discount from prime. And if they need to make up for losing however many millions, billions of dollars of these fees are generating, right, they're going to cut down the discount from prime. They're going to have a bigger spread on their fixed rates, all those kinds of things. So, I think there's things that are being done. Finally, the government is looking at housing and affordability and trying to do things. But it's just this kind of act to me is just a shuffling of the deck chairs. It doesn't make any impact whatsoever.
No. And honestly, if you look at the big picture moving forward, Jay, the global economy, the world economy is slowing down quite a bit. I think don't listen to the narrative. I just don't believe that. I think things are going to change in 2024. It's going to be an interesting year. Where's housing going to go? I don't know. I hope for many people that are trying to get into the market that we do see housing come down some more, because it's so expensive. I know it's not as expensive where you are in Alberta, but it's still crazy out here, and it's very unaffordable. And with these high interest rates, it's a double whammy, right?
Yeah, and the terrible thing for those people, like it's tough for people trying to get in the market. You're absolutely right. People got into the market 2 years ago. That's going to be a big kick for them if housing goes down significantly, right? You know, all of a sudden you own a house that you paid 800,000 for that's only worth six.
Yeah.
That's a tough thing as well, right? So tough market to get into. But as we talk to clients that are buying, renewing, refinancing, what I'm seeing with a lot of my clients right now, like you said, I just about everything I've done within the last 6 months has either been a 2-year fixed or a variable, an
Right.
adjustable mortgage, right? And so, I think we both believe in that. I've done a couple of 5-year fixed for clients who absolutely believe that they needed the lowest rate or needed to use the lowest rate to qualify. But the majority of people we speak to seem to think as well that this is a blip in the radar. Let's just get through this. We'll survive the next couple of years and then get back into a better rate environment, hopefully starting next year.
Yeah, and I think that's going to be the case. I think people think that, oh, you know what, things are going to turn bad and the government's going to come in and cut rates back to, nothing and print money, and which they may do. I have no idea. Wouldn't surprise me, but it doesn't mean that the economy is going to turn around on a dime just like that, right? It's going to
Yeah.
take some time. Just look how long it's taken us to get from where they started increasing rates to here. Like I
Yeah.
never ever thought they would get this high, but it's the big lag effect, right? We've talked about this every week. The lag effect takes time for the money to get through the system. It takes time. Everybody has to come up for refinancing and renewals at different times, right? So once that starts hitting people, they have less cash flow. What are they going to do? Spend less in the economy. Economy is going to slow down. So there's everything pointing towards slower economies worldwide, especially in our area here. You just look out there, like boots to the ground, like even your own family, like it's more expensive to do things these days, right? So people are going to spend a little less on things they don't necessarily need to. So it's going to happen. It's part of the business cycle. I just hope it's not as bad as what could be, right? So
Yeah. So I think that's it for us this week. The ever optimistic mortgage brokers from Alberta and BC.
It'll get better.
We honestly feel that it's moving and things are going to start moving in terms of affordability of mortgage rates in the right direction heading into 2024. So if you're renewing in the next 6 months, if you're buying right now, definitely give us a call. Mike in BC, me in Alberta, always happy to have a chat.
Have a good one. We'll see you next week. Thanks, Jay.
Yeah. Bye.
Bye.